Hi, Savji Chatterjee, recording our Chartsarefun weekly session. This is for the week of May 12th, recording this on Saturday, May 17th. This was a very interesting week. The market shot up with huge optimism of the China trade deal that was announced over the weekend. And on Monday, President Trump and Chair Xi announced that they would put a 90-day hold on the tariff from 145% that US had levied on China down to 30%. There are even talks that this might be for the rest of the year, but right now there's huge optimism that from the 145 it has come down to a 30. There was other massive trade optimism with the Middle East. President Trump was in Middle East. There was 210 Boeing jets with GE engines that were ordered by Qatar Airways. There was a massive semiconductor news with NVIDIA. All the beneficiaries of semiconductors did extremely well with a massive rollout of AI data center in Saudi Arabia. And technology stocks hugely did well. Industrials did well. There was just overall massive euphoria. And then everything came to a bit of a disappointment, or call it a bearish concern by the close of trading. It was also options expiration. You'd have thought that there would have been some downside, but not really. The market closed at the highs of the week. S&P had a massive almost 5.5, 5.7% rise for the week. But after the market closed on Friday, there was Moody's, the third and last agency that downgraded US's credit rating. This is US as a country from AAA to down a notch. Started off all back in 2011 when the first downgrade came from S&P. Then Fitch did their downgrade in 2023. Moody's was the last credit agency standing, and they did their downgrade this Friday. Concerns of US mounting debt over 36 trillion, huge deficits. We know that US budget spends are anywhere about 6.8 to 7 trillion. We get tax collections of about say 6 trillion or so, actually 5 trillion of tax collection. So a 1.8, 5 trillion of tax collection, a deficit of 6.8, a 1.8 net deficit. So 6.8 is the total spend on the budget. So 1.8 trillion, which is, if you look at a 36 trillion as GDP, a very large percentage of our GDP effectively is over 6%, 6.4% of the GDP is where our deficit spending is. This is not sustainable. There's almost 9 trillion plus of debt that's maturing this year that needs to be refinanced. We know Scott Bessent and President Trump have been talking about long-term treasury yields and so on. So we'll look at, after this news came out, what were the proxies? We know that the bond market closes, so it was not going to trade in after hours. But a proxy to that is the long-term ETF for treasuries called TLT. We'll look at the TLT's after hours trading to see where and how much it fell. We will look at small caps. We know small caps are extremely sensitive to interest rates. We'll see the ETF for that, the Russell 2000 ETF IWM. How did that perform? We will also look at the broader indicators for the S&P 500. As we said, we had an outstanding week in S&P 500, but broader technical indicators are kind of signaling some form of a rest coming up in the S&P 500. We'll look at that. And then finally, we'll end with Bitcoin. We know that Bitcoin trades 24/7. We'll see over the weekend, because after the after hours closed at 8 p.m., we had no other way to see how the market was performing. But Bitcoin trades 24/7. So we will look at, as of Saturday evening, when we're doing this recording around 8:40 p.m. or so Eastern time, we'll see how Bitcoin is trading, and we'll see what that signal that's telling us about the market open on Monday, and for that matter, when the futures open Sunday evening. So with that, let's jump right into our blog site. It's chartsarefun.substack.com. We appreciate you subscribing to our blog. We'll send it to you as soon as it comes out. Our YouTube site is also called Chartsarefun. It's youtube.com/Chartsarefun. Appreciate you subscribing to our channel, and if you like the videos, we appreciate you hitting the like button. So I talked about Steve Cohen. He's the founder of Point72, a very well-known hedge fund in Wall Street. There was a conference, investor conference in New York City this week, and in there he gave a talk, and he kind of talked about sees a strong possibility, 45% probability of recession coming up in the next several months. And he also seemed quite concerned that the S&P 500 would likely retest the April 7th low, which is, as we know, was at about 4,800, 4,835. He's not the only one. We've had Paul Tudor Jones express caution. We've had Ray Dalio. He's been calling, but the skies are falling. He's been extremely cautious about U.S. losing its reserve currency status, U.S. losing its kind of dominance in the exceptionalism perspective for quite some time. So there are many pundits in Wall Street who have becoming extra cautious, and even very well-known the stock market technician Katie Stockton was on CNBC last week, and she expressed concerns as well, potentially S&P retesting the lows. That said, some bullish folks have been out there. Tom Lee kind of was on CNBC. He raised a lot of optimism from what we had from before the tariffs to what we have now. He believes that the fact that the uncertainty on the tariffs is cleared off. We now know where it's standing between maybe 30% for China and 10% for the rest of the world. We know that there is a lot of optimism about tax cuts to be extended. We know that there is a lot of optimism about regulation to be relaxed moving into next year. And he overall is already started looking into 2026. Understood that 2025 may have some economic slowdowns, but he's beginning to get bullish on 2026. And since stock market is a forward looking instrument on the economy, he believes that stock market is going to react and do well in the next several months. And he continues to be very bullish and high optimism about this V-shaped recovery. Now, if you look at the longer term chart about our thoughts on recession, we've shared this before. This is on the top, we have unemployment rate, the topmost panel. Below that is the S&P 500. Then we have the yield curve steepening. Yield curve in this case measured by the longer term 10-year yield, subtracting from that the 2-year yield, which is a relatively shorter term yield. And then we have the 10-year and the 2-year Treasury yields drawn in the last two panels on the bottom. The vertical lines in purple are indicating every time the yield curve has started steepening. So if you notice that most recently towards late 2024, yield curve from underneath, as in from the inversion of the yield curve, it uninverted and started steepening. And we are right now at 47 basis points, 0.47 between a 10-year and a 2-year. In COVID times, we had the same kind of steepening. That's the 2020. Before that, around the financial crisis in 2007, we had a yield curve steepening. From there, from zero, it went all the way up to 250 basis points, almost 2.5%. Similar kind of yield curve steepening happened in the dot-com crash from 2001. Each of these effectively, and you can see all these times, are tough times for the economy. They kind of indicate recession. And the topmost panel on unemployment gives you the indications of the recession. Every time those happen, you can see that the unemployment rate goes higher. COVID, of course, is a misnomer. It was one time. Let's take the pandemic out. Look at the 2007. You can see unemployment went up almost there as high as closer to the 10% from somewhere below 4%. We can see that from 4 it went to 6% in the dot-com recession. Then in 1990, people forget that, but that was during the midst of a secular bull market. From 1980 to 2000, we had a 20-year secular bull run. Right in the midst of that, we had the Persian Gulf War in 1990. And there, unemployment also ticked higher as the yield curve steepened from zero all the way to 250 basis points there. So if you start comparing our current steepening to the previous cycles, in my opinion, what seems closest is what happened in the 1990 timeframe. There, what ended up happening was the Federal Reserve came and cut interest rates by 500 basis points. From 8%, the Fed rate came down to 3%. And in that process, the yield curve steepened because the short-term rate came down significantly faster than the long-term rate. As a result, the differential caused the yield curve to steepen. But the yield curve on the steepening did not lead to the long-term Treasury rates going higher. It also came down, but not at the pace with which the shorter-term 2-year rate, because the 2-year rate at the end settles down onto where the Fed funds rate is going to be headed towards. So we can see that that steepening had a market correction, happened while the Gulf War was going on in that summer. But it was exactly the same percent as the correction we had, and a very sharp correction in a span of 3 months Guess what the S&P's drop was? In that span of 3 months, S&P felt exactly what it fell in the month from February to April 19th in this year. We fell 21.4%, a beautiful Fibonacci number. 78.6 is the Fibonacci. So if you take the peak, take 78.6% of that, that's the level. So 61.47, 78.6 of 61.47 is 48.35. That's exactly what the S&P's drop was. The same thing happened in 1990. But since that drop of 21.4, look at the V-shaped recovery. It pretty much climbed all the way from a level of S&P at 300 to over 1500, a factor of 5x. We are of the opinion that we are setting up. This was almost instead of a Gulf War, this was a trade war, almost done to help bring the rates lower. Yes, at the expense of some recession for sure. We do expect the unemployment rate to climb. Right now, it's been holding flat at the 4.2 level, but once it starts climbing and crossing the 5, it can gradually and quickly rise to 6. So what we have seen in the past with every yield curve steepening, unemployment rates going higher, we expect the same to be happening. In the next few months, we expect jobless rates to be creeping in, employers not hiring as many, concerns overall with the slowdown from these tariffs. As much as people think it's transitory, the higher rates is going to disrupt the supply chain to many ways. Companies can just drastically change their manufacturing, move it out of China and move it elsewhere. It just takes time. And in that process, jobs, unfortunately, will get lost. So unfortunately, we do see some form of recession setup, but stock market looks at the longer term. And like in 1990, that dip was what indicated the recession. From there, look at how unemployment came right back down. And over the rest of the decade through 1990s, 1992 to remaining 2000, unemployment steadily came lower. We believe the same. Initially, it will unfortunately cause unemployment rate to tick higher to 6% by sometime in 2026. Then 27 onwards, we expect the unemployment rate to start coming back lower as the economy powers higher. Interest rates, the key, will drop is what we feel. We feel that the 2-year yield right now hovering around 4%, we can see it's at 4.01, will come down below 2%. So that's where we believe the interest rates are headed. There will be rate cuts coming, and those rate cuts by next year will definitely get us something around the 200 basis points, or likely get us 200 basis points of cuts. And that cuts of the rates will help trigger the economy into growth and more jobs, and be effectively bring America growing and powering higher highs like we saw in the 90s. That's what we're optimistic about. Talked about the Moody's rating. This is the Wall Street Journal article. Moody's downgraded, and they pointed to the tax cuts that President Trump is thinking about. They pointed to the deficit spending. As much as Scott Bessent is keen to bring it down from over 6.4% down to 3%, as in he wants to bring the deficit spending down to $1 trillion or less. Still hasn't happened. It's not going to be easy with tax cuts in the play. You're going to bring, if you get tax cuts, what's going to end up happening? That 5 trillion of income that the government got through the taxes is going to come down. And if that comes down at the expense of, they do expect that some of the tariffs are going to offset those tax cuts, but it really won't add up in that fashion. Tariffs are no longer as high as everyone feared. So it's going to be interesting to see what happens to the deficit that Scott Bessent wants to bring it to 3% of the GDP, which is about $1 trillion or less, is his goal. We'll see if that ends up happening. But Moody's has already raised a flag, raised concerns, and from AAA, the rating of US government's debt has been brought down a notch. As I said, the key proxy to volatility. Volatility is an indicator that has an ETF called UVXY. We can see how it shot higher. From somewhere around the 21 where it ended, it shot higher to 23.59 in a very parabolic fashion. This news came out about 4:40 p.m. or so. That's exactly when we see that it shot higher. It was kind of trending lower after hours. And from 4:40 p.m. onwards, it tracked from 21s all the way to 23.59, pulled back sharply to 22.5 and closed over 23. This is the UVXY. VIX correlating closed around somewhere, I think, look at VIX's chart. It closed, it has been sharply from the 60 that it saw on April 7th, has drastically come down towards the 17 handle. But VIX will likely be seeing a 23-24. I would not be surprised to go see a retest of this. The blue line is the 50-day moving average around 25.8, 26. I would not be surprised to see VIX climb up. Not immediately on Monday, but over the next several days, I could expect to see a VIX climb. And that VIX climb would, of course, mean that market potentially could have a pullback. Now, I talked about the other proxy to see how the bond market reacted. After all, you're downgrading US as a government, uses government's credit rating. That means you should have immediate impact on treasuries. But the treasury markets are closed, but the proxy to that, the long-term treasury ETF, TLT is trading, and look at what that did, a waterfall decline. From 86.45, 86.3 is where it was hovering in after hours. Right after that, Moody's downgrade came up. You can see that immediate decline from 86.3, settled at 85.5, immediately rebounded to 85.9, and settled down near 85.4. It's a support level, as we can see from a couple of days before. That's 85.4 is where it is at. But if you kind of span out and look at the TLT chart on the daily chart, we can see that there is a gap from the early part of January in 2025, left right at 84. So from 84, it had gapped higher towards 85. So that gap at 84 is where we think TLT will likely fill and maybe find support at this critical level at 83 and 84. That's where we think it'll settle down. And we seem to be optimistic because I talked about the rate cuts. I talked about the fact that this yield curve steepening will come with both 10-year and 2-year rates coming down. We believe 2-year rates are going to go below 2% because of 200 basis points of cuts. And we believe that potentially as the recession fears unemployment, because we've heard Chair Powell talk about his two mandates, right? Keep employment steady and also keep prices steady. But we know that inflation has pretty much come down drastically with oil prices coming down. Inflation data that has been printing recently has been way below what many markets were expecting. So it's trending towards the 2%. So Fed, in essence, is watching the labor market, and any signs of labor weakening will start the rate cut cycles. And as I said, we are expecting over 200 basis points of rate cuts in the next couple of years. So in that perspective, if long-term yields don't really go up that many are fearing, think that, oh, it's going to go past 5%, but we actually form in the TLT chart, in the long-term weekly chart, a beautiful inverse, which is a bullish head and shoulder pattern. We can see that in the 2022, we saw a pullback to the 83.47. We call that the left shoulder, tested 100. That's the neckline of this inverse head and shoulder. We tested a lower low at 73.3 around the 2023 market bottom. And look at the beautiful positive divergence. When the second low came of TLT from 83 to 77, RSI was at a higher low. That means this is a beautiful bottom that is formed because of the positive divergence in RSI. Same thing with MACD. A much higher low in MACD had formed when the second lower low happened from 77 versus 83. If we pull back to 100 again, 99.84, tested the neckline. Now we are effectively doing a double bottom test in that 83.7. We saw an early 25, we saw an 83.7. We believe because of the a credit rating, a pullback towards that left fill of 84, maybe 83.47 will get retested again. And we believe from there, that'll hold, a right shoulder will form, and we will come back and break above 9,900. That neckline of 9,900, take the 77 towards the 98. You're talking about 21 points. At the 21 to 98.84 and 99, 120. That's where we think it's headed. 120 was the last level we can see from where it broke down back in early 2022. That was support, 120.47, and from there it broke down. We never came back there, but I think this is setting up as a point where it's a contrarian move. Many are expecting higher yields, many expecting yields to shoot up to 5% and higher. We believe, if any, the administration is behind long-term yield reduction. They're doing everything they can to help bring yields down. They'll bring confidence in foreign investors on treasuries. They'll bring opportunities for rate cuts, kind of helping trigger the economy back higher and bring some promises of growth and so on. And as a result, though there will be temporary recession with unemployment creeping higher, that will eventually recover out of it strongly. And we believe TLT will have that breakout and move towards 120. That's where we see TLT go. Small caps have been also directly influenced by rates. And we know that with the yield rate cut that, the rating cut that US got, look at the waterfall drop in IWM, the small cap ETF. It was near the 209, 210. That has been a key resistance. I'll show you why it was a resistance on the weekly chart. From there, at a waterfall drop 210, it came down to 206 very fast in after hours. You can see this candle that it dropped was right at 4:40 p.m. Steady, like drop after drop after drop after every candle. Deeply oversold, but this is not where it ends. We believe, look at the weekly chart of IWM, we believe it has come back from a very sharp move from 171 to 209. So that's roughly 38 points. We believe it has a right shoulder pullback. So there's a neckline resistance at 209, 210. So the left shoulder here was 196, went to 209, came to the head of the inverse head and shoulder at 171, failed exactly at that neckline at 209, 210. Pull back. So we saw already in the aftermarket, it was at 206. We've been another 10 points towards 196 is where we expect. So we would be buyers if the IWM pulls back to 196. And that's also around where the 50-week, like the 200-week moving average is, around 194 to 196. This is a beautiful buying point. I would definitely consider buying small caps at that 196 level, bringing back a huge recovery if that breaks out of the inverse head and shoulder, measured to 248, above the previous highs that we saw in kind of late December or early December of 2024 at 243. In fact, sometime around not even December, in late November, we saw the 243. So I expect IWM to climb back and hit 248 after it breaks out of this inverse head and shoulder. So very bullish on IWM, but near term, expect that right shoulder pullback to 196 and an excellent buying opportunity. I'm going to now talk about S&P 500 and show you the beautiful gap higher. The China tariff news and all the Middle Eastern deals that were announced by President Trump got the euphoria gap higher on the China news on Monday. The entire week, this is a weekly chart, a weekly trade. We can see it left a gap at that 50 week moving average was 57.20. It left a gap right there. And it basically opened at the lows of the week at 5,800 and closed at the high near 59.58. That's like an amazing climb, a very bullish candle. And look at the volume, higher than the previous week. So there was strong volume. Bears would say that, look, the MACD is come and going to test the histogram, is going to test the center line. And guess what happened in 2022 at the beginning of the drop? Beginning of the drop, the S&P 500 came below the 50-week moving average. Then it recovered, went above the 50-week. But then that's when the waterfall decline came in and lower lows came in. Bears would tell you exactly the same. Oh, look, it did cross it, but then it failed and it did came down because of the Moody's rating. The sky's falling. This is going to just break lower and going to break 4,800. In fact, Kunlak was on CNBC when the Fed rates were announced, and I mentioned that in our last week's video, talked about 4,500 as his target. Expect 4,800 to break. He's raised a ton of cash. He's waiting for 4,500 before he inches back into the market. So there are many out there. Pundits, the very well-known pundits, are bearish on the market. However, we don't think that's the case. If any, there's strong momentum. Only thing is, near term, yes, there are signals for a pullback. Look at the bullish percent of, these are bullish percent missed by the point and figure chart. That, look at from where it came from 10% all to the 76%, and look at that MACD histogram. Whenever MACD histogram forms a beautiful bell shape above the zero line, it keeps cycling back and forth. It forms above the zero, then below the zero, above the zero, these bell shapes. So right now we are about to dip below the zero and form a beautiful bell shape underneath the zero line. As that MACD histogram forms a bell shape underneath the zero line, that's when we get the bullish percent come down. As we typically see, it goes up and it comes down. We expect it's already RSI at 71. We expect it to dip and come down lower as the BP comes lower. Market's percentage bullishness will come down. Another indicator of market internals is the percent of stocks that are above the 20-day moving average. That cycles from single digits to 83 to 90%. And look at in the August timeframe, on the August 5th low, it shot up to 92.8, sharply fell down to the 27 in the next couple of weeks, and then came back to 83. We're expecting a similar, look at the MACD histogram, same picture as the bullish percent. It's carved out a beautiful bell shape above the zero line. Now it's time for it to form a bell shape below the zero line. A bell shape below the zero line would come when the percent of stocks come down from the lower high from 88. It touched 86 on Friday. We believe this will come down over the next couple of weeks. And as this comes down, the bullish percent, just like the MACD, the bullish percent, the MACD of the percent of S&P above 20-day will also form a bell shape below the zero line. And with that, the market will pull back. Another indicator of extreme, call it, complacency is the put call ratio. That's the total. There is equity put call ratio called CPCE. This is CPC, the total put call ratios. That means it includes all the stocks and the indexes. And in the indexes, guess what's covered? VIX. VIX is an index. When you have a lot more call buying on VIX, put call ratio comes down. There's huge volume of VIX options trading. So VIX futures, the tremendous amount of call buying was going on because market, the smart money was thinking of a volatility spike. And that volatility spike caused more call buying on the VIX, and that overall, the put call ratio means the call is the denominator, put is the total volume of puts versus calls. When there's so much of call buying going on, the put call ratio comes down. So from 1.22, it fell to a level that we haven't seen in the entire last year. You can see 0.72, 0.69 was as low as it went. And this week on Thursday, it hit 0.68. It went slightly up to 0.69. But this put call ratio having come down this extreme from 1.23 indicates complacency. It indicates near-term possibility of the market to have a put call ratio spike, which typically comes with vol spike, volatility increasing. And we've already saw that with the volatility ETF, UVXY climb in the after hours on Friday. So as the UVXY climb, it's a good chance VIX will cross above 20, and as I said, likely hit towards the 25 in the next several days, and that would mean the put call ratio would begin to climb. Finally, one part that is very bullish, this is a longer term, these others are all short-term indicators, is the summation index. This is a McClellan summation index indicating overall market breadth, and because it's a long-term indicator, it typically cycles from minus 1100 to plus 1100, as we can see. And the most recent bottom was a higher low than what we saw in the 2022 bottom and the 2020. So whenever market bottoms, the summation index bottoms, and when the summation index climbs, the market climbs with it. And when the summation index climbs, these intermediate cycles, it tends to go in a monotonic way. So we can see in 2023, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 to 12 weeks is when this cycle climb happens. And we are right now in the midst of that. We're only 1, 2, 3, 4, 5. So we've got another 6 to 7 weeks of climb in the summation index. And as that climbs towards the 1100, that's when the market would hit some form of an intermediate peak. Near term, we expect that a pullback on the S&P 500 likely comes and closes that gap near that 5,700. We do expect some form of a pullback, and then a break higher to test that 61.47 and break even higher. So if you take a 48.35 to a 61.47, talking about roughly, from 48 to 61, you're talking about 1,300 points added to 61. That's a huge, huge upside of 7,400. Not right away. We expect at least the test of the 61.47 this year for sure. In fact, in the summer likely, then maybe some form of a pullback towards, a kind of a cup and then a handle and then the breakout. But we wouldn't be surprised to see a level somewhere in the 66, north of 6,600 in the end of this year. So it could, after all, when all the pundits in the beginning of the year were making predictions for S&P to end the year in that 6,700, 7,000 region, we got to see maybe after the pullback we see in the July through the September timeframe, then the next climb could take us near that 6,500 level is quite possible. And then Bitcoin, as I talked about, I want to show you the 10-minute chart of Bitcoin. And right here this is the Greenwich Mean Time. This trades 24/7. So on Friday, when we were doing at 440, that's 840 in Greenwich Mean Time. So it's between 8 and 9. We see that the drop happened from 104 towards 103.5, but not that waterfall drop. That shows smart money isn't panicking on Bitcoin with the US credit rating downgrading. The smart money holding crypto doesn't think the crypto should get impacted by that whatsoever. Later after midnight is when The Greenwich Mean Time, midnight, is when after our market closes on the US. 8 p.m. because right now we're having a 4 hour. Greenwich Mean Time is usually 5 hours from East Coast, but it's because of time change when it'll coordinate later, in another few weeks, it'll become 5 hours. But right now it's a 4 hour difference. So 8 p.m. is when the after hours closed, and that's exactly midnight at Greenwich time. After midnight, which is from 17th of May, which is 8 p.m. Eastern, is when we start kind of a sharper drop with some volume. So it's hard to explain. Maybe these traders wait for the US market to close and then they move the cryptos around, but this is when the drop happened. But so far it's been fairly well contained. It stopped at 102.6, came back immediately in the next couple of hours to 103.8. It's been hovering around, retested that low today on Saturday in the like I would say in the morning time frame. Greenwich Mean Time is about 10 a.m. at same 102.6, 102.7 got tested twice and has been trending higher. So we'll see where Bitcoin trades Sunday into Monday. We wouldn't be surprised to see it. In fact, if you look at the daily chart, this is a beautiful flag pattern, a bullish flag. So we can see three major climbs from that April 7th low at 74.4, a major climb, then kind of consolidation flag, then another climb into after April 21st, a consolidation flag, then the third climb after May 8th or 9th, and then a consolidation pattern. We wouldn't be surprised to see it retest the previous highs at 109. That 109 was in January, December was 108.4. So between 108 and 109, we'd expect Bitcoin to test that. And then maybe like we see this pullback from 108 to 91, 90,000, we could get that right shoulder pullback of an inverse head and shoulder. So if you draw the neckline at 109, the left shoulder is at 90K, back to 109, head at 74.4, up to 109. So 74.4 to 109, you're talking about roughly 35,000. Add 35 to 109, that's 144. So that's perhaps where we think Bitcoin could be headed once it breaks 109. And this could happen this year, this summer, in fact, with the momentum that Bitcoin has already got. We can see the 50-day moving average is beginning to trend higher. 200 was anyway trending hard. This is a very bullish setup. We expect that golden cross of the 50 above the 200 coming up in the next several days, and then from there climbing. And as the 50 goes above the 200, with the 200 climbing, it's a beautiful bullish setup. We won't be surprised whatsoever to see Bitcoin break the 109 and head towards that 145 to 150K. With that, good luck investing. To sum it up, we feel that, yes, there are indicators in the after hours trade. We can see that volatility spiked higher. So do expect some selling into next week. Post options expiration, anyway, market sees selling. And this is timed, unfortunately, with the US credit rating downgrade. So that volatility spike indicates some selling coming up into next week. TLT indicates a drop. We'd expect TLT to come and maybe retest that level of 83.7. In fact, TLT's gap at 84 would get closed. There's a very good likelihood TLT does that. Small caps to us has tanked badly because it's rate sensitive. We think IWM is headed to a retest of 196. A golden opportunity gets there for those who believe in the US economy. You can make America great again only through small caps. So if America is going to be great again, small caps have got to be outstanding in the performance. So we believe small caps would be a perfect and great buying opportunity at that 196 level to climb it to 248. And once it breaks 248, it goes a lot higher above to 320 is our target. The IWM. S&P 500, we believe, had a bullish week, climbed over 5.2%, gapped higher. We do believe that gap will close once it pulls back, closes that, and then resume its climb and retest that February high at 61.47. Once that consolidation after that retest happens, then we expect it to break higher and head towards 66, or even towards its measured target is almost as high as 7,400. And these indicators are all there showing this MACD crossovers, indicating near-term very good chance the weakness in the market comes in. These are all S&P related, the bullish percent of S&P, the S&P percent of stocks above the 20-day. These are all S&P related, indicating S&P will have downside as the MACD carves out a beautiful bell shape from below the zero line. And the put call indicator is also extremely complacency should start climbing as more puts start getting bought, as market starts fearing about a correction. There'll be lots of people calling for retest of the lows and then be more put buying. So we would expect to see put call to maybe have a shoot back up. The total put call back above 1 is like we saw in the September timeframe and in the end of October timeframe. Typically, every few weeks we see a put call climb to 1. We wouldn't be surprised to see the put call climb back over the 1 in the next several days. And then a bit intermediate term indicator shows strong strength in the climb. Monotonically, it climbs for 8 to like 10 to 12 weeks. We've only midst of it of 5-week climb. There might be a short bit of a pullback like we saw here in the late August timeframe, and then the continued climb. So we may get a summation index pullback for a week or two, and then resumption of the climb towards the 1100. Until the summation index gets to the 1100, which is typically a market peak, I would not just look into like taking gains or any of that. Hold on and start looking at booking gains only at that summation index at the 1100, because from there we could expect to see like an intermediate term top and a few weeks of selling that could maybe give you a like 5 to 10% correction. But till then, we might get a shallow correction next week because of the debt downgrade, but we expect the market to coast higher. The summation index in particular is keeping us very bullish. With that, good luck investing. We'll talk to you next week. Thank you.